On the Fed, and with the wild market swing, certainly this is something that people down here at the floor are talking about. We're down 437 right now heading into the close. And how will the volatility in the market affect the Fed, and what will the Fed do next? Fox Business exclusive now. Dan North is Chief Economist, North America, Euler Hermes. And Ward McCarthy is also with us. Ward is former Richmond Fed Senior Economist, currently at Jefferies, where he's Chief Financial Economist. And let me go to you, Ward, first on this. And the timing, something Peter got into. I think we were talking about it yesterday. Some part of you says, oh, how much does it matter? Quarter point. I mean, get it out of the way. Let's get this done in September. Well, how much does the timing of this rate hike, which we all know is coming at some point, really matter?
Well, it does not matter a whole lot for the economy. I agree with President Rosengren on that. But, of course, if you're involved in the financial markets, you want to know when the Fed is going to start raising rates. And the consistent story they've told us is they expect it to happen this year, but there is clearly a disagreement among Fed officials about which opportunity they'll use, at September, October, or December. I've been thinking they'd squeeze it in under the wire in December for really quite some time, and right now nothing's happened to really dissuade me from that view.
And I think that split that you're talking about on the Federal Open Market Committee is what creates some of the uncertainty, Dan, in the financial markets, and we've heard that from people down here on the floor of the stock exchange. You hear it from everybody that the Fed wants to be transparent. They talk a lot. Federal Reserve officials talk a lot, but they don't often or always say the same thing. So now people are wringing their hands about when they're going to raise rates. Your thoughts on timing?
Well, I think that September is probably pretty unlikely, and it's much more likely to be December, maybe even moving out to next year as well, because there are a couple things really arguing against it. First of all, you don't have the wage growth that you'd like to see. Janet Yellen has said for a long time she wants to see the wage growth, and it's not really there just yet. And we don't have inflation. The PCE core, which is the favored measure, is at 1.2% year over year and is falling. That's way off the Fed's target. So if you look at employment and inflation, to me, it looks like they're not meeting either mandate. And then you have the participation rate, which keeps going the wrong way. And that's really an impediment. And now, yes, you have volatility. The Fed understands that the stock market is not the same thing as the economy. But global volatility in the financial markets is something that would probably push their decision back till at least December.
Well, that is, and let's take a couple of those things. You look at some of the stocks that are down. By the way, the Dow's 417. All the financials are down. Just about everything is down today. Those are some of the things, wage growth and inflation, that Dan brings up, Ward, that we could talk about a little bit, because can you make a counter argument to that? Because he's right. We haven't seen the wage growth, right? And we haven't seen the inflation. So then why should the Federal Reserve raise interest rates if we haven't seen those things?
Well, I especially agree on the inflation front, because the Fed has lowered the bar from having to meet an objective of 2% inflation to being reasonably confident that they would meet a 2% inflation target. And I don't see how in this environment they can be reasonably confident about anything on the inflation front. Most of our deflationary pressures are imported, and import prices are down 10% on a year-over-year basis, and that ends up getting passed through to consumers within a relatively short lag. So I think what we need to see is some stability in commodity markets before anybody can be reasonably confident that we'll start moving towards the 2% target.
Or maybe there's a number, Ward, I'll go back to Dan in a moment on this, but Ward, maybe there's a number Friday we get on jobs, that says, all right, now we're there, or is there nothing that can happen Friday? Is there a number we could see?
As far as the labor market is concerned, the Fed's pretty happy with what's happened. We maybe not quite where the Fed would like us to be, but we're pretty close. The labor market's not going to keep the Fed from doing whatever it wants to do. Okay. The issue is inflation and also market volatility.
And we see plenty of that, certainly on the market volatility side, down 400. Again, I mentioned earlier, the last 10 minutes, if you're watching the show today, of trade, a lot of people are talking about how important that might be. What about, Dan, from where you sit, do you agree that the Friday number is not as important because of those factors? And you already brought them up that you mentioned earlier, kind of outweighing what we'll see in terms of job growth and unemployment rate?
I think you'd have to have a report that's way off of expectations. I mean, I think you'd have to completely blow it out one way or another for them to even, for that to influence their decision. We've seen lots of strong growth for the past couple of years, quite likely to see it coming on Friday. And there's so much else that's been going on in terms of fundamentals, that wage growth, that inflation that's not going to change very rapidly. I can't see it being an enormous influence.
Yeah, it'd have to be huge. All right, that's fair enough. Dan and Ward, thanks to both of you for joining us. Good big picture discussion on the economy. We're going to get back to the minute-to-minute